Let's say you buy a stock at $100 expecting it to go up in value. But let's say it doesn't go up in value. Let's say it goes bankrupt. Let's say the company folds. Well, you lose $100. Your $100 investment is gone. You now have zero. You lost $100. But if you think that $100 stock is going to go down and you short it, you borrow the stock, you sell it for $100. You have $100 in cash. But what if that stock goes up to $400? Well, now you have to buy it back at $400. You've lost $300. So your potential losses are actually theoretically unlimited. That stock can continue to go up and up and up in price, and you have to buy it back at some point. So you really expose yourself to a lot of risk when you short a stock. So that's what brings us to the craziness this week with Robinhood, GameStop, AMC, etc. So if you're on the internet, I mean, you could not have avoided seeing some kind of reference to it. You may not have known what people are talking about, but you probably saw some reference to everything this week. So here's what happened. Hedge funds. And hedge funds are these more sophisticated, very difficult access funds to get into. You have to meet these certain requirements and be what's the term? An accredited investor. That's the word I'm looking for. And so hedge funds are supposed to be these really sophisticated funds that use special investment vehicles and have access to different types of investments that are not available to the general public. But these hedge funds will oftentimes use options. They will use margin. They will use shorting stocks in order to generate a return for their investors. So these hedge funds looked at GameStop and they looked at their underlying fundamentals and they thought, GameStop's in a vulnerable position. GameStop does not have good fundamentals. Their earnings, the changes that are coming to the gaming industry are not going to be good for GameStop. We think that their price is going to go down, so we're going to short their stock. And they took some very large short positions against GameStop. So these are large investors, large hedge funds, large amounts of money. Well, along comes this Reddit community of small individual investors, and they noticed that there was this large volume of short positions on GameStop. So they realized something. This is an opportunity that we can capitalize on. These hedge funds are going to have to come back and buy GameStop stock at some point because they've taken the stock, sold it, expecting for the price to go down, and at that point they will rebuy it. But they have to rebuy it at some point. So here's what we're going to do. Let's go and start buying up as much GameStop as we can. And the added demand, when we have lots more buyers than we have sellers, that's going to raise the price. So the price is going to start to go up. And then the hedge funds are going to realize, oh no, the prices are going up. We should buy the stocks now before they go up too high. It's called a short squeeze. And then when the hedge funds come in to buy the stock as the price is going up, the increased demand is going to continue to push the price up even higher. Because if there's more buyers than there are sellers, then the price is going to have to come up to a reasonable level. It's just supply and demand economics. So that's what was going on. And it happened to GameStop, and then it happened to AMC. So basically, these hedge funds are playing these games all the time to try to capitalize on price movements. And this Reddit community was basically we're going to beat them at their game. Because what a lot of times the hedge funds will do is they'll recognize a stock that they want to short. They'll see a position they think is weak. So they will they'll take up short positions against it, but then they will simultaneously start to bash the stock. They'll start to talk about how weak and vulnerable it is. They'll try to go on TV and talk about how people should be really thinking twice about the stock. And once the market sentiment is bearish against that stock and the price starts to plummet, then they capitalize and exercise their short positions, buy and take the profit. So really, it's a matter of somebody seeing the game somebody's trying to play and then trying to beat them at that game. And in this instance, the Reddit community really did do just that to a really astounding degree. But here's the problem, and here's what caused a lot of the controversy. So this week, the prices of GameStop, prices of AMC started to soar. All these investors were pouring all the money in, short squeeze, but then brokerages like Robinhood and some others, they started to restrict the trades. They came in and started to not allow their users, their clients, their customers to buy the stocks anymore. They could sell them, but they couldn't buy anymore. Now, this was most likely due to pressure that was being put on them by the clearing firms. So they were probably experiencing pressure from those who are on the inside facilitating these trades, and the ones who are going to get creamed by all of this added activity. But the hedge funds and the larger firms, they were not being restricted. So the smaller retail investors were being locked out. Meanwhile, the industry insiders were able to continue to trade. And so, I mean, it's really, in my opinion, it's really a prime example of a double standard. Now, the rationale that was given, that was offered as far as why they did this is we're protecting retail investors. If they come in and buy the stock where it is right now, it's way out of line. Now, just by the way, let me give you some context as far as prices here. AMC was trading between $2 to $5 for this last year, $2 to $5 a share. And since this added influx of demand from the Reddit community and then the short sellers, it jumped up to almost $20, and then it's since fallen back down, and I think right now it's trading at around $9 to $11. But GameStop's the one that just took off astronomically. GameStop had been trading about $3 to $4 a share at this time last year. That's where it was. And then it came up over the year. It started this month at around $20 a share. But then with all of this added demand, it jumped up to over $450 a share. I mean, we're talking more than 100 times what it was trading at last year. So there is no way that the price of GameStop is reflective of the true value of the company. It's just simple supply and demand and increased buying that has rocketed the price up to where it went. And even now, it's still trading at around $250 a share right now. So just really, really crazy. And just so volatile all over the place. So the idea was, okay, well, we're protecting our customers. We're not going to let them buy GameStop right now because the price is so out of line with its real value. It's going to come crashing back down, and we don't want our customers to get killed by making a foolish choice to buy right now. And now you can believe that rationale if you want. You can believe that Robinhood is really, truly trying to act in the best interest of its customers. That does not happen to be my opinion. But really, to me, I think what this is an example that insiders, they're allowed to use whatever tricks at their disposal to try to manipulate prices and seize on opportunities for their own gain. But as soon as the little guys, quote unquote, little guys team up and try it at the big guys' expense, then they're quickly shut down. And I think that's exactly what we've seen this week. So again, the irony here is that Robinhood has positioned themselves as the champions of the small retail investor. And they're the ones that come along and restrict trading. And so you got a lot of people who are very mad at Robinhood, and understandably so right now. There have been some lawsuits that are in the works, some class action lawsuits potentially. So we're going to see what legal action, if any, comes down on Robinhood, if there's a settlement, if they have to pay for their actions this week. And so that's going to get into the legal realm, and I'm not the legal expert, so I can't tell you what I think is going to happen there. But it's all interesting, to say the least. Now, here's the other irony, and here's the other thing that I find very interesting about this whole situation. It's that even though the hedge funds are the ones that typically try to use these tricks at their disposal, they may not be illegal technically, but I think many people would consider it underhanded at least. The hedge funds themselves usually don't beat the market. And it seems crazy because they're only sophisticated, quote unquote, accredited investors are allowed to invest in hedge funds. These are supposed to be these really sophisticated tools. They're supposed to be able to generate superior gains for their clients because they're using these advanced investment techniques. They have access to these investments that are not available to your regular average small investor. But the vast majority of hedge funds underperform the market. They don't do better than your regular diversified portfolio S&P 500 index fund type of investor. It seems crazy, but it's true. And not only that, but these hedge funds charge much higher fees than your typical mutual fund or ETF. So these are supposed to be like these super funds. They're way more expensive and they underperform. Many of them charge what they call 2 and 20, so 2% management fee. So the managers are charging 2% of what the client is invested, how much the client has invested, plus they charge 20% of the profits. Now, a lot of them actually charge a little bit less than the 2 and 20. Some charge even more. But regardless, I mean, the fees are way higher than what you're going to see in a typical mutual fund or ETF. And the sad reality here is that many people are investing in hedge funds thinking that it's the best way to beat the average investors, that we're in this elite club now, and so we're going to be able to do better than you because we have all this, these special techniques and special investments available to us. And the average retail investors, many of them, are beating the sophisticated hedge fund investors. Now, by the way, the hedge fund managers themselves, they do just fine. In fact, they're making tons of money. So it's okay for them that they're not beating the market because they're earning tons of fees from their clients. But anyway, it's just ironic all through and through that those who kind of position themselves as the champion of the small guy or the big guy oftentimes are not as advertised. So bottom line, I'm going to wrap this up now. Bottom line, Robinhood has a lot of nice features. Honestly, there's a lot of things that I actually enjoy about the Robinhood app. It's very easy to use. I would say it's even a fun app to use. But there's a reason that I don't use Robinhood for where I invest my serious long-term money because it has some limitations for sure. So what happened this week, it once again underscores the importance of transparency in the financial world. And I come back to this theme over and over again. Money, your finances, your investments are so important. They are so personal. Besides your faith and your family, I would say your finances are the most personal thing to you. And remember, I mean, the Bible teaches us the love of money is the root of all evil. And we see it over and over again. There's lots of money to be made in the financial markets, and that greed gets inserted, and it can drive people and companies to do some very shady things. So just be careful, stay informed. I hope that this podcast has helped you. I hope it's clearer now to you what has been going on this week. So if you ever have a question, feel free to send me a message. Send me a message on Facebook. You can send me an email, info@nateskelly.com. If there is a topic that you'd like for me to cover on the podcast, I am all ears. I would love to hear your suggestions, so send those to me as well.